Between February and November 2024, the wealthiest individuals on the planet unloaded more than $50 billion worth of stock, not over years, not quietly, but through massive clustered transactions that sent shockwaves through trading desks and risk departments. Jeff Bezos liquidated over $13 billion in Amazon shares. Mark Zuckerberg sold more than $9 billion in Meta stock over a steady drumbeat of transactions. Jamie Dimon, CEO of JPMorgan Chase, executed his first stock sale in nearly 2 decades of leadership. Larry Ellison disposed of $3 billion in Oracle. The Walton family offloaded $2-3 billion in Walmart. And Nvidia insiders flush from the AI rally that pushed valuations to historic highs, sold $1.2 billion, while confidently promoting to the public that the best is yet to come. This is not rebalancing. It is not the mechanical selling that occurs to diversify after vesting cycles. It is not strategic tax optimization. It is an exit wave. The most informed actors in the system are quietly approaching the emergency doors, and they are doing it at the exact same moment, using the same tactics they used in 2007, right before the financial crisis vaporized $16 trillion in value and sent markets crashing over 50%. The pattern is not subtle. It is loud, coordinated, and executed by people who do not make impulsive calls. These are not ordinary shareholders. Jeff Bezos built Amazon from a garage, navigating the dot-com implosion, the 2008 crisis, COVID, and every macro storm along the way. He has seen fear, exuberance, irrationality, and collapse. Jamie Dimon has been at the helm of the largest bank in America since 2005. His institution sat at the epicenter of the global financial system in 2008. He survived. He negotiated with regulators, central banks, sovereign wealth funds, and CEOs in boardrooms where systemic failure was the only agenda. These men do not panic. They do not wake up and sell billions without reason. They make decisions based on data streams that retail investors will never see. Internal forecasts, loan books, inventory cycles, delinquency curves, and geopolitical exposure models. The numbers whisper long before the news screams, and those whispers are telling them something deeply unsettling. Get out while the market is still euphoric. What most people misunderstand about insider selling is not the raw dollar amount, but the context. Insiders are corporate executives, board members, and major shareholders who sit at the bleeding edge of non-public intelligence. Product delays, client attrition, manufacturing issues, political risk, regulatory exposure. They submit their trades to the SEC within 2 business days. These filings are public, searchable, and transparent, but almost nobody reviews them consistently. Most investors stare at earnings reports, price charts, or analyst opinions without ever questioning what the people closest to the engine are doing. This matters because insiders occupy a vantage point ordinary investors cannot replicate. Bezos knows Amazon's margins, shipping costs, AI's usage rates, competitive threats, and regional demand patterns months ahead of the rest of the world. He sees what customers cancel, what markets slow, and which government regulators quietly form committees. Jamie Dimon does not read about the economy. He has a living model of it, flowing through the balance sheets of millions of individuals and businesses. He can spot recession through tightening lending standards, debt stress in commercial real estate, corporate downgrades, rising charge-offs, and the sudden silence of new credit demand. By the time the media announces a downturn, his analysts were already discussing it 6 months earlier. Insider selling is systematically tracked. The most reliable long-term database is maintained by the Washington Service, monitoring such transactions since the 1970s. Their key metric is the insider sell-to-buy ratio, comparing dollars sold versus purchased. A healthy equilibrium sits around 2:1 or 3:1. Executives sell a little, buy some, pay taxes, manage estates. Nothing dramatic. When the ratio breaches of 1, analysts start paying attention. When it crosses 8:1 or 10:1, the alarm bells start blaring. In 2024, the annual ratio hit 1. In some months, it surged to 12:1. For every $1 insiders bought, they sold 9. It is the most extreme imbalance since 2000, and history shows us what tends to happen next. Look at the individuals behind the data. Bezos publicly filed plans to sell 50 million Amazon shares when the stock traded around 70 over February and March. He executed roughly $8 billion worth. Then he announced another plan. This time, 25 million shares at a 100. Through summer and fall, that tranche generated roughly $4 billion more. These actions exceeded $13 billion in total, compressed into a single calendar year. His previous record was around $10 billion across 2020, but that was during a chaotic rebound from a global pandemic. The 2024 sales came at market peaks, at a moment of euphoria, when sentiment insisted AI would rewrite every industry. Bezos publicly cited taxes and a move to Florida, but Bezos has been a billionaire since the late 1990s. He could have relocated at any point. He chose the year when valuations touched all-time highs. People call this tax optimization. It looks a lot more like timing. Mark Zuckerberg's selling followed a similar rhythm. Throughout 2024, under prearranged 10b5-1 plans, he liquidated hundreds of millions month by month, $200 million in January, $400 million in February, $50 million in March. The conveyor belt never stopped. By November, he had offloaded more than $9 billion. Meta's stock price tripled from its 2022 lows, fueled by efficiency campaigns, layoffs framed as innovation, and a rhetoric promising limitless monetization. At the peak of that optimism, Zuckerberg pocketed billions. His official narrative was philanthropy, the Chan-Zuckerberg Initiative. But Zuckerberg, unlike normal investors, controls Meta through disproportionate voting power. He could borrow against shares at extremely low interest rates and keep control indefinitely. He chose not to. That is not simply funding charity. It is capturing liquidity at a macro ceiling. Then comes Jamie Dimon. When someone who has never sold in nearly 2 decades suddenly sells, the signal is seismic. He disposed of 1 million shares, around the $155 to $165 range, worth approximately $160 million. The explanation: estate planning, family diversification. Dimon is nearly 70. He could have diversified at any stage of his career, but he waited until the moment the U.S. banking system faces record commercial property exposure, shrinking deposit bases, accelerating consumer delinquencies, and policy uncertainty. Dimon sees the economy not as headlines, but as cash flows, defaults, liquidity deserts, and failed loan recoveries. His sale is not reactionary. It is preemptive. What makes this period even more dangerous is the macro context surrounding these sales. We are in a market that has been propped up by low interest rates, stimulus, and corporate buybacks for over a decade. Much of the valuation expansion is not rooted in organic growth, but in leverage and artificially cheap capital. AI has become the latest narrative bubble, absorbing trillions of speculative capital, the same way housing did in 2006. Analysts insist the rally is durable because this time is different. That exact phrase has preceded every historic crash. When insiders exit, they are not gambling. They are insulating themselves from a future they already glimpsed. They do not need to predict the exact trigger, whether it is a commercial real estate collapse, sovereign debt crisis, credit contagion, or geopolitical disruption. They act one step ahead. The general public never sees the trap door until it opens. Afterward, commentators will call it unpredictable. But if you trace the money, the warning has already been issued. The most dangerous part of the next downturn is not the decline itself, but the velocity. Markets supported by narrative instead of fundamentals do not decay, they implode. Capital does not rotate out slowly. It evaporates. Those who bought at the top will be trapped. Those who ignored insider selling will wonder why everything broke at once. The richest people in the world already know the answer. Larry Ellison represents the moment the fire alarm stops blinking and starts ringing. As the co-founder and chairman of Oracle, Ellison sold around $3 billion in Oracle stock during 2024. Oracle's valuation had surged on the back of AI infrastructure. Every company building AI systems needs databases, training clusters, cloud systems, and enterprise compute. Oracle offers all three. And that made investors euphoric. The price moved from roughly $80 in early 2023 to above $140 by late 2024, nearly doubling on expectations of endless growth. At the peak, Ellison, who has remained deeply invested since 1977, quietly liquidates billions. He is not selling because he needs cash. He is selling because the market price is disconnected from what he sees internally. Sales pipelines tightening, AI infrastructure demand plateauing, and a customer base more excited than profitable. Ellison, worth more than $150 billion, is not panicking. He is simply reading the scoreboard. The Walton family, heirs to one of the greatest retail empires ever built, offer another clue. In 2024, Jim Walton sold around $1.5 billion in Walmart stock. Alice Walton sold roughly $500 million, and Obed Walton sold around $300 million. These are not impulsive trades. They are generational decisions. Walmart stock is their identity held for years, weathering recessions, inflation, dot-com mania, and the 2008 crisis. They almost never unload large blocks at once. And yet in 2024, all three siblings executed major sales within months of one another, as Walmart crossed all-time highs above $80 a share. When ultra-patient dynastic wealth exits simultaneously, it is because they no longer see upside worth sitting through the storm. Then there are the Nvidia insiders, riding the most spectacular rally of the modern era. Nvidia became the oxygen supply for the AI revolution. Hyperscalers, hedge funds, sovereign funds, everyone piled in. Valuations climbed so violently that Nvidia briefly became more valuable than all of Germany's stock market combined. Insider selling from Nvidia executives was not a fluke. It was a pattern. Liquidity extraction during the wildest bull stampede of the decade. When insiders repeatedly sell into exuberance while externally preaching abundance, they are signaling one thing. The hype has outrun reality. Zoom out, and the numbers become apocalyptic. Total insider selling in 2024 hit $464 billion, second only to 2007, at $650 billion. The year before the worst crisis since the Great Depression. The year before real estate imploded. The year before the S&P plunged 15%. The next closest comparison is not 2019 or 2021. It is the prelude to catastrophe. If 2025 continues tracking at the same pace, it will surpass even 2000. You are not seeing coincidence. You are seeing cycle mathematics unfold again. The first historical pattern is that insiders sell 12 to 24 months ahead of major market peaks. In 1927, insider sales exploded more than 300% in the first half of the year. The market crept upward until late summer, then crashed violently in October. In 2000, insider selling peaked months before the dot-com implosion. The Nasdaq hit its summit in March before collapsing 78%. In 2006, $6 billion selling preceded the October peak, and the ensuing plunge wiped out a generation of investors. The timeline is always the same. Insiders sell, while prices are still rising. Retail and institutions keep buying, and by the time the cracks appear, the insiders are already in cash, waiting for the ruin. This is how wealth transfers from the public to elites. Sell at night of the top. Watch prices fall 50 to 60%. Return and buy the ashes. They do not need to predict the exact day. They only need to be ahead of the stampede. Pattern 2 revolves around the sell-to-buy ratio. The Washington service, which has tracked insider trading since 1975, has global credibility because the metric is behavioral, not opinion-based. When the ratio remains above 8, 1 for a sustained period, a crash has followed every single time, 8 for 8, with 0 false signals. In 1987, the ratio hit 9, 1, and the market broke months later. In 2000, it peaked above 11, 1, before the Nasdaq imploded. In 2007, it crossed 8, 1, and climbed to 10, 1 by autumn. The collapse began immediately. This is not a loose pattern. It is statistical brutality. In 2044, the ratio clocked 1 for the year. In the third quarter, it reached a jaw-dropping to 1. If the pattern holds, the crash window lands between late 20 and 20. Pattern 3 is sector-led selling. Before the dot-com implosion, tech executives dumped stock, while the Nasdaq was still blasting upward. They knew valuations based on eyeballs and future growth had no anchor in earnings. In 2007, financial executives were first through the exit. Lehman, Bear Stearns, countrywide, because they alone had visibility into toxic loan books and ballooning defaults. Now in 2024, insiders are selling in tech and financials again. Nvidia, Meta, Amazon, Oracle, AI-driven, hype-dependent tech, JPMorgan. System-exposed financials. The sectors that led previous crashes are the ones insiders flee from. First, because they represent the highest multiple and the deepest structural risk. If you want a roadmap, This is it. Tech and banks lead the downturn. Pattern 4 is psychological rather than statistical. When the most successful long-term holders in history become net sellers, the top is near. Bezos held Amazon for 3 decades. Zuckerberg held Meta since its creation. Dimon held JPMorgan stock through wars, recessions, and pandemics. Ellison held Oracle since before the internet existed. These individuals endured every correction because they understood their companies better than anyone. The fact they are exiting now together means valuations are at levels not justified by their internal data. They have lived through bubbles before. This one is no different. Their actions scream, this is as good as it gets. Pattern 5 is the most devastating. Whenever insider selling exceeds $400 billion in a year, markets do not make new highs within the next 2 years. After 1987, it took nearly 2 years to recover. After 2000, 7 years passed before markets reclaimed their peaks. After 2000, 6 years of recovery and stimulus were required before new highs appeared. You do not break a record of $464 billion in selling and immediately go on to fresh highs if history holds. The peak is either behind us or directly in front of us. The rest is decline, stagnation, and eventual slow recovery. To understand why billionaires are selling, you must understand the lens through which they view risk. They are not reading headlines on CNBC. They see the Buffett indicator, total market cap divided by GDP, at 185%. Historically, markets are fair when the ratio sits around 82 to 100%. Above 120% becomes expensive. Above 150% signals bubble territory. At 185+, stocks would need unprecedented productivity gains or decades of hyper-growth to justify valuations. Neither is plausible. Productivity has already been mined through automation and cost slashing. Easy adoption may alter workflows, but its profits are already priced into valuations years before they materialize. The indicator must revert to its historical mean. That implies a 40–50% drawdown from current levels. Billionaires can do math. They do not wait to confirm they are right. They act. They also see the Shiller-Cape ratio, measuring prices against a decade of inflation-adjusted earnings, sitting in bubble territory, rivaling 1929 and 2000. Cape does not care about quarterly enthusiasm. It cares about structural sustainability. The last 2 times it reached these levels, markets endured multi-year bloodlettings. Insiders do not debate Reddit threads about AI. They understand that earnings cycles revert, multiples contract, and liquidity dries up faster than optimism. The public still believes they are early to the party. The insiders know the party is almost over. The Shiller-P ratio exists for a simple reason. It smooths out the noise. Instead of reacting to quarterly earnings or short-term market optimism, it accounts for inflation-adjusted earnings over a decade. That makes it one of the best tools for understanding long-term market valuation. Historically, its mean cites around 16 to. When the ratio falls below 20, markets are cheap. When it rises above 25, they are expensive. Above 30, it enters bubble territory. Today, the Shiller sits at 34. That puts it well into danger. And this is not an abstract number. Only 3 times in history has the ratio pierced above 30. In 1920, it peaked at 3rd before the market imploded, and a depression followed. In 2000, it reached 44 before the dot-com bubble collapsed, wiping out half of market value. During the COVID crisis, it briefly touched 38, and markets fell 38 before emergency policy flooded the economy with liquidity. The pattern is not subtle. Each time valuations detach from reality and venture beyond 30, a crash follows within 3 years. Investors may ignore this. Politicians may ignore this. Retail traders always ignore it. Billionaires never ignore it. They study history because they are the ones who write it. They also see leverage at historic extremes. Margin debt. Money borrowed to buy stocks is the accelerant that turns normal corrections into violent crashes. When optimism rules, traders borrow heavily. When fear returns, they unwind. Margin debt reached $950 billion in late 2020. 24, nearly an all-time record. Leverage magnifies both directions. A 10% rise becomes a 20% gain. A 10% drop becomes a 20% loss. If markets drop 30%, investors do not simply lose money, they are forced to liquidate. Brokers issue margin calls, and investors must sell assets to cover loans. That selling accelerates the fall, triggering more margin calls, and the cycle spirals. This is how cascades form. In 2008, margin debt peaked at $850 billion. As markets fell, forced liquidations accelerated, and debt collapsed to $280 billion in 18 months. That $570 billion of involuntary sales did not just contribute to the crash, it became the crash. We are now repeating the same setup, only with even more leverage. Billionaires know that when the cycle turns, $90 billion in borrowed exposure becomes an avalanche of forced selling. They sell early, quietly, and patiently. They do not wait for CNBC to explain what already happened. They also see the commercial real estate implosion coming long before the headlines. Office buildings in major U.S. cities sit half empty. Remote work is not a temporary adjustment. It is an entrenched shift. Properties purchased between 2019 and 2021 at peak valuations, financed by fee loans, are now worth 40% or less. Those mortgages mature, and refinancing at 7% and 8% destroys the cash flows. The math is brutal. A building that worked at Fred interest collapse at 7%. When hundreds of billions in property values deteriorate simultaneously, banks eat losses, pension funds lose collateral, and insurers face systemic pressure. It is not a slow burn. It is a synchronized repricing of an entire asset class. Billionaires also see the corporate debt time bomb. Most people ignore. Companies collectively owe about $13.5 trillion, much of it borrowed between 2009 and 2021, when rates were near zero. Those bonds are now maturing and must be refinanced at 6%. Firms built to survive on financing cannot survive at 7%. Bankruptcy is the logical outcome. We are seeing early examples already. Bed Bath & Beyond, Party City, Rite Aid, and Silicon Valley Bank are the visible casualties, but dozens of others are following the same trajectory. Between 2024 and 2026, $4 trillion in corporate bonds mature. If just 10% default, that is $470 billion in losses. Bond prices crash. Credit spreads explode. Investors flee risky debt, and capital becomes unavailable, precisely when businesses need it most. When companies fail to refinance, their equity does not decline. It goes to zero. Insiders know exactly which companies are vulnerable. They see their balance sheets. They understand the math, and they are selling before the bankruptcy wave peaks. The sixth pillar of their logic is the federal debt spiral. The United States owes more than $36 trillion. Deficits exceed $2 trillion per year. Interest payments have surpassed $1.2 trillion annually, already greater than the U.S. military budget. If rates hold at 5%, interest costs will approach $1.8 trillion within a few years. Numbers that annihilate fiscal credibility. The government has three paths: cut spending by trillions, politically impossible; raise taxes massively, economically destructive; or print money and debase the currency. None of these outcomes are positive. All eventually trigger either a debt crisis or a currency crisis. Billionaires do not debate morality. They hedge. They shift to hard assets, durable equity, and foreign exposure, reducing their dependence on the dollar long before the rest of the population understands the danger. The final factor is invisible to the public: internal corporate data. Bezos does not look at headlines or analyst forecasts. He looks at Amazon's raw metrics, real-time sales, internal forecasts, consumer demand trends, advertising revenue velocity, margin compression, AWS cloud, growth flattening as enterprise clients cut budgets. Zuckerberg sees Meta's real engagement numbers: declining user time, weakening at auction prices, soaring infrastructure costs for ATI that may not monetize. Jamie Dimon sees loan quality at JPMorgan deteriorate, delinquencies rise, charge-offs increase, commercial real estate portfolios rot. None of this hits earnings reports until quarters later. By the time retail investors discover the rot, insiders have already exited. Combine these elements and the conclusion is unambiguous: stocks are 40–50% overvalued. The economic engine is decelerating toward recession. Defaults, both corporate and commercial, are accelerating. Federal debt is mathematically unsustainable. Internal metrics show deterioration before the public even sees it. The risk-reward for holding equities is terrible. Perhaps there is 10 to 20% upside if the bubble inflates further, but the downside is catastrophic: 50–60% if the system breaks. When you are worth $100 billion, risking $10 billion to maybe make another one is absurd. Selling now is rational, not emotional. It is self-preservation. History provides the timing window. The average lag between peak insider selling and a market crash ranges from 6 to 18 months. In 1987, heavy insider selling preceded the crash by half a year. In 2000, insiders dumped stock in late 1999, and early 2000 the crash began immediately. In 2007, insiders sold throughout the year. Markets collapsed that October. In 2024, insider selling surged, especially in mid and late year. If the pattern repeats, the danger window opens in 2020 and stretches into '26. And this time, multiple crises converge: commercial real estate maturities, corporate debt refinancing, exploding deficits, political uncertainty, and an exhausted consumer base. The trigger could be anything: a bank failure, a default cascade, a geopolitical shock. It does not matter. When a system is leveraged, fragile, and overvalued, the spark is irrelevant. Once selling begins, algorithms accelerate it, ETFs amplify it, and panic completes it. The S&P could fall 30–50 in less than a year. Anyone still holding high-risk assets will be forced sellers, and nobody becomes wealthy selling at the bottom. In every crisis cycle, the winners are the same: insiders who sold high, waited, and bought at half price. Bezos cashes out at $80 per share. If Amazon falls to $90, he doubles his share count without spending an extra dollar. Zuckerberg sells billions at $40. If Meta trades at $225, he accumulates twice as many shares. Dimon sells JPMorgan at $160, buys back at $100. The rules never change. Sell high, wait for blood, buy low. That is how generational fortunes are built. Ordinary investors think wealth is created in booms. It is not. Wealth is created in crashes by those holding cash and real assets, while others liquidate in fear. Gold protects purchasing power when governments print. Cash becomes a weapon when prices collapse. People who allocate defensively survive. People who chase momentum become collateral damage. The cycle is predictable. The question is not whether the crash comes. It is who prepares before it arrives. Short sellers are often portrayed as villains, but in crashes, they are simply the people who understand the mechanics of gravity. Betting against overvalued markets can generate extraordinary wealth. Michael Burry earned over $700 million shorting subprime mortgage bonds in 2008. John Paulson famously made more than $15 billion during the same crisis. Bill Ackman made $2.6 billion in March 2020, shorting corporate credit as the pandemic sent markets into chaos. These trades were not lucky guesses. They were calculations rooted in understanding how leverage unwinds, how liquidity evaporates, and how fragile optimism becomes when reality intrudes. When short sellers identify a bubble, they profit enormously. The catch is that the timing is merciless. You can be right about the fundamentals, right about the coming collapse, and still lose everything if you are early. Markets can float for months or even years on hype, liquidity, and hope. Most people should never short. It is a weapon for experts who can endure volatility, margin calls, and psychological warfare. The billionaires know this. They are not shorting the market. They are doing something far more effective. They are selling and raising cash. The real losers in a major downturn are not the hedge funds or the ultra-wealthy. It is the middle class. Most of their net worth is concentrated in three places: retirement accounts, home equity, and savings. In a severe crash, all three are vulnerable. Retirement accounts are typically allocated to equities. A person who spent 40 years saving responsibly might enter retirement with $800,000, believing they achieved financial security. A sudden 50% market decline turns that nest egg into $400,000. At 65, you cannot simply work another decade to recover the loss. Your window has closed. The dream collapses, not because you were reckless, but because you grew up being told that buying stocks and holding forever was safe. This is the human cost of economic upheaval, responsible people being destroyed by timing. Large institutions are vulnerable too. Pension funds like CalPERS manage hundreds of billions of dollars on behalf of public employees. If equity markets fall 40–50%, they do not simply take a paper loss. They confront structural insolvency. They must cut benefits, raise contributions, or beg state governments for bailouts. Municipalities buckle. Retirees see promises reduced to fractions. Insurance companies face a similar fate. They hold vast portfolios of bonds and equities. When both asset classes drop together, their capital cushions evaporate. Policies become liabilities. They cannot pay. The interconnectedness of the financial system ensures that when one domino falls, be it real estate, credit markets, or equities, the others follow. Leverage accelerates this destruction. Many retail investors borrow to increase their exposure, not understanding how violently margin calls strike. If you own $100,000 worth of stocks using $50,000 of borrowed margin, a 30% decline wipes out your equity. Brokers then liquidate your holdings automatically. You do not get to wait it out. You are forced to sell at the worst possible moment. This is how wealth is transferred from those who are overexposed to those who hold liquidity, from the unprepared to the prepared, from the middle class to the billionaire class who saw the pattern early and acted. So what can an ordinary investor do? You cannot prevent a crash, but you can position yourself to survive it and profit from the recovery. The first step is to reduce equity exposure. If you are 80% in stocks, move toward 40 to 50%. Yes, you may miss the final euphoric rally if markets rise another 10 to 20%, but you will preserve capital when they fall 40 to 60%. That is how professionals operate. They do not chase the last percent of return. They protect the next decade. Second, allocate 10 to 15% to gold. Physical bullion or gold-backed ETFs are not glamorous, but they serve a purpose. When economies collapse, politicians and central banks panic. They print money to stabilize markets. That monetary flood inevitably devalues the currency. Gold does not require trust. It cannot be printed. In 2008-2011, as the Federal Reserve unleashed unprecedented stimulus, gold doubled. In 2021, during the COVID shock, it gained roughly 50%. It will rise again when the next flood of liquidity arrives. Gold is not an investment for growth. It is insurance against the failure of institutions. Third, create a buy list now. When markets are crashing and commentators scream about the end of capitalism, you must know exactly what you are buying. Great companies with durable balance sheets, strong cash flow, and essential roles in the economy. Firms like Apple, Microsoft, Visa, Costco, Johnson & Johnson. These are the businesses with the capacity to survive downturns and dominate recoveries. When their prices are cut in half, do not improvise. Execute. Deploy cash systematically. Fortune favors those who buy quality when everyone else is fleeing. Fourth, do not short unless you are a professional. Shorting is not simply profit when stocks fall. It requires perfect timing, psychological resilience, and the ability to endure massive unrealized losses. Bubbles can inflate far longer than your patience or your brokerage account can withstand. The great short sellers are rare for a reason. Billionaires understand this. They are not trying to make fortunes from the collapse itself. They are preparing to make fortunes after the collapse, when assets are cheap and competitors are dead. Fifth, protect your income. In a recession with 10% unemployment, careers disappear. Build an emergency fund large enough to cover a year of expenses. That buffer allows you to avoid forced selling. The greatest investor advantage is optionality, having the capacity to wait. Without liquidity, every downturn becomes a disaster. Sixth, prepare psychologically. Crashes do not feel like buying opportunities. They feel like the end of the world. News media will broadcast panic non-stop. Friends and family will tell you the system is broken. Your retirement account may be down bishost and you will want to sell before it goes to zero. That is the moment when wealth transfers. The rich buy, while the terrified sell. If you cannot steel yourself emotionally, your strategy will collapse. Discipline must be built before the crisis, not during it. Look at the signals. Over $50 billion in insider stock sales from the most successful Cs and investors. More than $40 billion in total insider selling. The sell-to-buy ratio at 91:1, the most extreme since the months before the 2008 crash. These are not random coincidences. This is not diversification or routine profit-taking. This is coordinated exit. The smartest people in finance are sprinting toward liquidity. They see the Buffett indicator hovering around bubble levels, the Shiller P above 30, record margin debt, collapsing commercial real estate, a corporate refinancing crisis, spiraling federal deficits, and deteriorating internal company metrics. They have lived through this pattern before. The same script played out before 2008. Heavy insider selling. A period of calm, then sudden collapse. History rarely repeats perfectly, but it rhymes with cruel accuracy. We are in the window again. The crash may begin in late 2020 or stretch into 20s, or arrive earlier if a catalyst hits. The exact spark is irrelevant. The system is brittle. One shock triggers the avalanche. Billionaires know this. Their actions speak louder than any warning. You now have a choice. Ignore the signals, trust hope, and pray you retire before the collapse, or recognize the pattern and adapt. Reduce equity exposure. Raise cash. Hold gold. Build a buy list. Prepare mentally, because the next 12 to 18 months will reshape wealth and power. The billionaire exodus has already begun. They will survive the crash and buy what you are forced to sell. The pattern is clear. The crash is coming. Position yourself accordingly.